For thousands of years, tightrope walking has captured the imagination of audiences around the world. The earliest known mentions of this ancient art trace back to Egypt, around 2000 BC. Over centuries, it has transcended cultures, becoming not just a performance, but a universal metaphor for balance, precision, and resilience. Today, the Federal Reserve finds itself on its own high wire, balancing conflicting priorities as it holds interest rates at levels unseen in decades. Its goal? To tame inflation. But beneath this balancing act lies a cascade of mounting pressures. The staggering costs of U.S. debt interest, a commercial real estate crisis, and rising risks to small and mid-sized banks. Each misstep could send ripples across the economy and through the prices of gold and silver. Will the Fed find its footing, or are we headed for an economic fall? And how might investors in gold and silver prepare for what's ahead? Before we dive in, if you value untold stories and unique insights about gold and silver in today's fast-moving world, hit that subscribe button. Your support helps us bring balanced, thoughtful content to your feed each week. Thank you. For years, the United States has been living beyond its means. National debt now exceeds $36 trillion, with annual spending surpassing $7 trillion and a budget deficit of over $2 trillion. According to the Congressional Budget Office, the interest on this debt alone will reach $892 billion in 2024, more than the nation's defense budget. This sharp rise is largely due to the Federal Reserve's rapid interest rate hikes to combat inflation, driving Treasury yields higher and inflating borrowing costs. In 2024, interest expenses are projected to be a third higher than in 2023. This growth is unsustainable yet necessary as the Fed works to restore price stability. However, these higher rates don't just impact government debt. They're also exacerbating a brewing crisis in commercial real estate. The commercial real estate sector, valued at $20 trillion, faces unique challenges in today's high-rate environment. Unlike residential mortgages, which are typically long-term loans with fixed rates, CRE loans operate differently. They often come with shorter terms, usually 5 to 10 years, and include a balloon payment at the end. When these loans mature, property owners must refinance at current interest rates. Here's where the trouble begins. Let's say an investor purchased an office building for $1 million using a 1% loan years ago. Monthly payments were manageable under those terms, but with rates now hovering around 7%, refinancing at today's rates could nearly double their monthly payment. Compounding the issue, property values have dropped significantly in the wake of remote work trends and declining demand for office space. In many cases, the building's loan-to-value ratio has risen above 100%, meaning the property is worth less than the outstanding loan. This leaves landlords in a bind. To refinance, they may need to inject significant cash to bridge the gap. A bank will not typically approve a loan for more than the building is worth. Those unable to do so face default. As Charlie Munger observed earlier this year, a lot of real estate isn't so good anymore. There's a lot of agony out there. The consequences of these dynamics are already emerging. In November, the delinquency rate for commercial mortgage-backed securities composed of bundled CRE loans spiked to 10.4%, approaching levels last seen during the 2008 financial crisis. Meanwhile, global CRE investment volume fell by 47% compared to the previous year, highlighting how stubbornly high rates and plummeting office values have cooled the market. Risk is not evenly distributed across the banking sector. Small and mid-sized banks, which account for the bulk of CRE lending, are particularly exposed. As defaults rise, these banks may face severe financial strain, potentially triggering broader systemic risks. Recent history shows us what form this risk may take. The collapse of Silicon Valley Bank in March 2023 sent shockwaves through the financial system, becoming one of the most significant banking failures in U.S. history. The bank's downfall was precipitated by a liquidity crisis, sparked by a mismatch between its long-term investments in low-yield bonds and the rapid withdrawal of deposits by tech companies facing a downturn in their own sector. The failure of SVB triggered a domino effect. Depositors, fearing instability in other institutions, began withdrawing funds en masse from several regional banks, causing what can only be described as a modern-day bank run. To prevent a systemic collapse, the Federal Reserve stepped in with extraordinary measures, introducing special lending vehicles like the Bank Term Funding Program. These programs aimed to provide banks with the liquidity needed to honor withdrawals without forcing them to sell off assets at massive losses. But despite these interventions, fear permeated the markets and a few other banks followed SVB into insolvency. Signature Bank and First Republic were among the most notable casualties, leaving regulators scrambling to reassure the public and restore confidence in the banking system. Amid the turmoil, a wave of investors turned to gold and silver as safe haven assets. Demand for precious metals surged and retail inventories began to dwindle as buyers sought to protect their wealth from the uncertainty roiling the financial sector. Prices of both gold and silver spiked dramatically, reflecting the heightened demand and the flight to stability. For many, these metals became a beacon of security in an increasingly volatile landscape, underscoring their historical role as a hedge against financial crises. The Federal Reserve faces a daunting dilemma. Keeping rates high risks deepening the CRE crisis and driving debt servicing costs into uncharted territory. Lowering rates prematurely, however, risks failing to tame inflation, which remains well above the Fed's 2% target. For investors in gold and silver, this balancing act carries significant implications. Gold thrives in environments where inflation remains high, but real interest rates are low or negative. Negative real rates occur when inflation outpaces the returns on fixed income investments, making gold an attractive store of value. Silver tends to follow gold's lead, amplifying the trend. The Federal Reserve's predicament mirrors the tightrope walker's challenge. Every step must be deliberate, balancing competing forces to avoid a disastrous fall. While policymakers may yet find a way to navigate these challenges with minimal disruption, investors should prepare for the possibility of economic turbulence. For those holding gold and silver, these precious metals provide a hedge against the potential ripple effects of rising defaults, bank closures, and broader financial instability. In a world of uncertainty, they offer stability when it's needed most. But let's end on a hopeful note. The tightrope walker rarely ventures out without a safety net, and the U.S. economy has demonstrated remarkable resilience in the face of past crises. Policymakers have tools at their disposal to address these challenges, and history has shown that ingenuity often emerges in times of greatest need. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.